Now what we're going to talk about is the effect of volatility on option prices. And this is a very, very important influence on option prices that's sadly often overlooked by amateur or novice traders. What we need to understand first is the effect of volatility on an option price. And I mentioned before in the last section that I have an online education series. I talk about volatility in an entire 4-part series and really go over all the nooks and crannies of volatility so that you really have a deep, profound understanding of it and talk about how to use it in your everyday trading. In the next section, I'm going to give you the means on how to enroll in my online education series. If you want some information about that, I'll give you all the contact information. Now, let's start out with the crash course here, and I'll tell you the things you need to know. Historical volatility is the volatility of the underlying stock during some sort of recent time period, usually 30 days. Historical volatility is the first type of volatility that we need to understand. The next type is implied volatility, and we'll get to that in just a second. Given this definition here, historical volatility doesn't necessarily have anything to do with options. It just tells me how volatile a stock is during the last 30 days. And then we take that measure of volatility, called standard deviation, and we annualize it to make those 30 days representative of the last year. So a stock that has a 30 historical volatility is more volatile than a stock that has a 20 historical volatility. A stock that has a 30 volatility is less volatile than a stock that has a 40 historical volatility. So basically it just measures fluctuations. It doesn't tell you anything about up or down. It just measures the magnitude of moves. Now implied volatility, on the other hand, that has everything to do with options. One definition is implied volatility is the market's estimate for the future volatility of the underlying stock. And it is implied by its options. I can give another definition that maybe I like a little bit better. It's the volatility component embedded in an options price. You think about it, options are like insurance contracts. And like your auto insurance, if you have a clean driving record, your insurer thinks, you know, you're not a big risk. So they're going to charge you a small premium. If you have a horrible driving record, your insurance company is going to think you're a big risk. You're a volatile risk. They're going to charge you a higher premium. The same for these insurance policies here. If there's a stock that's not very volatile, isn't expected to be very volatile, their option prices are smaller than a stock that is expected to be volatile, all else held constant. That's implied volatility. So as you can see, historical volatility and implied volatility have a little bit of an inherent relationship. They're two different things, but they're related. If the market collectively thinks that the historical volatility will be greater in the future, chances are implied volatility will rise and the options become more expensive. If the market collectively thinks historical volatility will be lower in the future, implied volatility will be lower as well, and option prices will be cheaper. Now, implied volatility is kind of a big deal. In some cases, it's more important than the underlying stock price changing. A lot of people don't think about this, but it's true. Let's go back to our example, the same hypothetical example we've been using. There's a stock at 40 bucks a share. There's 60 days until expiration. Implied volatility is 30. And that's stated as a percent. That's 30% annualized standard deviation. The at-the-money 40 strike call is 2. Now let's say that the stock price doesn't change. The days to expiration don't change. This all happens within 1 day. But implied volatility rises by 1 point. Look what happens. The 40 strike call rises to 207. So look, this is something you really must understand. The stock price or the days to expiration don't have to change, but the option price can change. And when that happens, that's called implied volatility changes. And look, if implied volatility rises another percent, the price of the call rises another 7 cents. In this same example, oh, and Gustavo's asking, what's volatility's magnitude, dollars percent? Yeah. This is I think I touched on this while you're typing the question probably. That implied volatility is stated in a percent, and specifically what it is annualized standard deviation. Here, if implied volatility falls a percent, my option gets worth less by 7 cents. If it falls another percent, my option gets worth less by another 7 cents. What we're talking about here is Vega, and this is really, really important. This is something you need to start watching, and it's going to clear up a lot of surprises that may happen to you. Option prices change as implied volatility changes. Nothing to do with the stock price changing, nothing to do with time passing. It's just this expectation for future volatility. That impacts option prices, sometimes profoundly. Now again, we have this in the money, at the money, or out of the money thing. At the money options are affected more by changes in implied volatility than in the monies or out of the monies. Longer term options are affected more by changes in implied volatility than shorter term options. The impact of implied volatility on option prices is measured by Vega. Vega estimates how much an option price changes as implied volatility changes.